High-low method. High-low method basically means we take the lowest point in our observation. So let's say again, so this is the sales output. So the sales turnover, so 100 million, 150 million, and certain operating expenses, so 90 million, 125 million. So let's say at 100 million turnover, we have 90 million operating expenses. That's the lowest point. We take the lowest point and the highest point. And let's say the highest point that we have measured, so if you look at the last income statements, we can see the highest turnover we made was 150 million, and there we had 125 operating expenses. Then what we can simply do is relate that to each other. So we see 100 output is 90 expenses, 150 equals 125. And basically what we then have to do is simply relate this to each other and see, well, what is the difference? The difference of sales between the 2 points is 50, and the difference between the operating expenses is 35. So if we then take the 35 and divide it by 50, so 35 divided by 50, we get to 0.7. So this, or 70%. This way we know that if we make €1 in turnover, we incur 70 cents in variable cost. And this is a very, very good observation, because then later, and I will also show this to you on a task that we do, we can actually say, and we can also do that here. So let's just take then we can take any of the situations. Let's take situation B. We have operating expenses of 125. And of course, there's a certain variable part in there and a certain fixed part. So, and we know the total costs are variable plus fixed. And if we know that 70% of revenue is cost, then it's going to be very easy. So then we have 125 euro equals to variable plus fixed cost. So 125 euro equals variable cost. And we know variable costs are 70% of sales revenue. Because if we have €1 in sales, we have 70 cents in variable cost. So it's simply 70% of the 150, euro, and then plus the fixed cost. And that basically is what we have to calculate now. So what we do is we take 70%, so 0.7 multiplied with 150, so that is 105 euro. And so 125 euro equals to this plus the fixed cost. And then simply what we have to do is trying to get the fixed cost standing alone. So minus 105 euro. So to get this on this other side, we would have 20 euro as our fixed cost. And this is the way we would calculate this. So we simply take the difference, relate the difference to each other. Then we know we have 70% or 0.7 per euro that we make turnover. And then we can simply take this information and put it into the formula. So in total we had this amount of costs equals variable plus fixed. So 70% of the revenue is then the variable cost, so 105, and then we take it to the other side. We can do the same thing also for the situation A. Situation A, we have a total cost of 90. So 90 euro equals to variable plus fixed cost. And so 90 euro equals variable, and that's 70% of the sales turnover. Sales turnover is 100 euro plus fixed. And then we have 90 equal to 70 euro plus fixed. And this minus 70 then would be 20 euro equals fixed. And so you see, in both situations it works. So we know our fixed cost per observation are 20 and the other part is variable. And so this is the way that we can calculate or use the high-low method to calculate our cost breakdown basically. So you can see that also here again on the slide. That is simply what we just did on the board. So we related to each other, and then also the 20 is the fixed cost that we have. Problem for this is, of course, if we have, let's say, 5 years of data, we only take the highest and lowest. So we ignore the vast majority of data that we have, which is, of course, a disadvantage. But this is the way we use the high-low method.